Alright, so in this video I want to talk about a trade I made yesterday, March 25th, using SPY credit spreads. But before I go into the trade, I have to talk about probability, so why I placed this trade. Alright, so if you've seen my previous videos, I talked about the SPY. I compared the closing price of the SPY versus the open price of the SPY, same day expirations as well. What are the probabilities that it lands within a certain percentage? So based on the whole history of the SPY, there is, as you can see here, there is a 99% chance that the SPY will close no lower than 3% of the open price of the SPY. Okay, so that's for the whole history of the SPY between the open and between the close. Okay, so that's a pretty good chance that if the SPY opens at a particular price, I could sell a put spread 3% lower, knowing that I have a 99% chance of winning, because I know that based on history, the SPY does not close lower than 3% of the open price 99% of the time. Okay, and if I want to be more specific, I also compared one of the worst years ever, which was the market crash in 2007, between 2007 and 2009, which was just a free fall. So just to be more specific and compare a period that's similar to what we're going through right now, which is worst case scenario. Okay, so if I do the same comparison between the open price and the closing price of the SPY, and I look at 3% range, I see that I have a 96% chance. Instead of 99, I've got a 96% chance that whatever the SPY opens at, it will not close 3% lower than, no lower than 3% of the open price. It's got a 96% chance of doing that. Okay, so once again, if I do a put spread 3% lower than the open price, I've got a 96% chance of winning if I had done this between the periods of 2007 and 2009. So why this works, like I mentioned in my other videos, is because even during crashes, most of the drops occurs outside market hours. So the market opens and it already made the biggest move between the close of the day before, the close of the previous day, and the open price. So most of the move is already done. Intraday usually does not move that much, and you have the probabilities here in front of you. These are not my data. This is data from Yahoo Finance covering the SPY prices since inception. All right, so now the problem I have with just selling a put spread 3% lower is, where do I stop? What is my stop loss? Just in case things go bad, right? Because when I open a trade, I use a 5-point spread. So my max loss is $5 or $500. If I do one contract, my max loss is $500 minus any credit I received to open the trade. Okay, so let's say I received $60 or $70. My max loss is the difference, 500 minus $60, so $440. Obviously that's a big amount, even though I've got a small chance of that happening, because that would only happen if the SPY closes not only below my 3% point, but it would have to close below the other end of my put spread, the long option leg of my put spread. If you don't understand what a put spread is, I'll link some videos below. It helps to really understand what the put spread is so that you understand this video better. All right, so now if I say that I give myself a stop loss of, if I collect $60, I'm going to close the trade if it reaches 3 times the credit that I received. So let's say it reaches $180, I'll close the trade. So how do I know when it reaches $180? So to really compare my probabilities, or to really know what my probabilities are of winning, I should compare the open price with the lowest price of the day. So to know how far what is the lowest price the SPY reaches intraday compared to the open price, because that will tell me how often I'm going to reach my stop loss. Okay, so if I look, I did the comparison here. So I did all between open and low. What are the probabilities? Okay, so between open and low, so the open price and the lowest price of the day, you can see that at a 3% 3% lower than the open price, it happens. No, the SPY does not go lower than 3% of the open price 99% of the time. So out of 6,837 occurrences, the SPY has not gone lower than 3% of the open price intraday 6,778 times. So 99% of the time, it does not go lower intraday than 3% of the open price of the SPY. So that's another really good probability. So that means that most of the time I won't be reaching my stop loss. If I give myself a mental stop loss of 3 times the initial credit received, 99% of the time I will not reach it. Now this covers the whole period of the SPY. Now let's look at 2007-2009 period between the open and the low. Let me just zoom it to make it bigger. All right, so what this tells me here at a 3%, so this says here that 95% of the time between 2007 and 2009, the SPY did not go lower than 3% of the open price during the day. So I'm not talking about closing, I'm talking what's the lowest it reached during the day between 2007 and 2009 compared to the open price. It has not gone lower than 3% of the open price 95% of the time. So that means 5% of the time it has gone lower than 3% of the open price. So that's still a pretty good probability. Now if I compare this probability here of 95% that it's not going to go lower than 3% of the open price intraday with the that it will close 96 or 97% of the time it'll close above 3% lower than the open price, then it gives me an edge. It gives me an advantage to sell a daily put spread on the SPY with the same day expiration. So that's what I did yesterday, but with a few mistakes. So what I did now, here, let me show you. Actually, before I show you, I just want to show you that the same thing applies on the upper side, on the call side. You could see that at 3% higher, so if the SPY opens at a particular price, it usually does not close. It has a 96% chance of closing no higher than 3% of its open price. So that's also a good probability. And that's between 2007 and 2009. It's got a 96% chance of not closing above 3% of its open price. Let's compare now between the open and the high of 2007 and 2009. So if we look at the 3% again, it says here that the SPY will not go higher than 3% of the open intraday. It's got a 92% chance of doing that. So it's got a 92% of the time, the SPY will not go higher than 3% of the open price during the day. So the highest price of the SPY intraday does not surpass 3% of the open price 92% of the time during 2007 and 2009. So these are all really high probabilities. So based on all that, here's the trade that I made. So the SPY opened yesterday at around 244. So I went 3% higher. Remember, because the probabilities were pretty high at 3% higher in terms of closing, of not closing 3% higher than the open price. I went 3% higher, and as you can see here, March 25th. So look at the March 25th expiration. The first thing I sold was a vertical call, so a call spread at a 252 strike. So the SPY opened at 244. I sold a call spread at 252, collected $80. Okay, so remember, my max risk is 5 minus any credit that I mentioned that I collected from this trade. That'll be my max loss. So I started off with $500 minus $80. So now my max loss is $420. But my max loss only happens if the SPY closes above 257. But I start losing money if it goes above 252. So I don't want the SPY to close above 252. So when I made that trade, it was around here. The SPY went up. I started getting worried. I didn't do anything, trusting the probabilities. And then look at that. The SPY took a big drop all the way down to 240. So it made my call spread pretty profitable. I did not close it. So that's my first mistake. But what I did when the SPY dropped all the way down to 240, it even dropped lower than the open price. I decided to sell a put spread lower, knowing that I've got a over 95% chance that the SPY will not close lower than 3% of the open price. So right now I'm at a 240 price. So I'm even lower than the open price. Plus I'm gonna sell a put spread lower than 240. So that's what I did. I ended up selling a put spread at a 232 strike, collecting $70, as you can see here. So now I collected $80 and $70. So that's a total of $150. So now my max loss is only $350. Okay. But look at my ranges. I'm 20 points away on same day expiration. So as long as the SPY closes between 252 and 232, I keep the full $150. But then when the SPY went up to 245, I actually had a chance to close the whole iron condor. So I had a put spread and a call spread, so it becomes an iron condor. I had a chance to close them all together for $75, so for 50%. So I would make a 50% profit in a few hours, but I didn't. I felt like I had a good chance of keeping the full 150. I felt like it was going to expire between 232 and 24. It was going to close. I felt like the SPY was going to close between 232 and 252 easily. And I didn't close the trade for 50% when I had the chance. And then the SPY, as you can see, started going up 251, 252, 253. And the highest of the day was 256. And then dropped back again, 251. And then it started going up again. So when it started going up, here's what I did. My put spread, the one that I collected $70 from, was completely profitable. It was trading for pennies, like 5 cents. So I closed it and I rolled up the 232 short strike. I rolled it up to 247 for a $58 credit. So I collected more credit. The reason I did that was to reduce max loss in case the SPY closed above 252. So I used a different method of stop loss. Instead of confirming a stop and instead of confirming a loss, let's say at 3 times the credit, I decided to roll up the put side, which is completely profitable, collecting more credits and giving the trade a chance to win. So as the SPY was going up, I rolled up the put spread. So I rolled it up twice. Rolled it up to 247 and then I rolled it up again to 251. So now I was left with a very tight range. My put was 251 and my call was 252. But I collected credits on the way. So at the beginning I collected 80 plus 70 plus 58 plus $45. So it's about $253 that I collected for this trade. And then the SPY towards the last 30 minutes, last 20 minutes, the SPY was trading at 254. So it was above my call strike of 252. So in my mind, if it closes at 254, I should be able to close the trade for about $2, $3. And then it started dropping below my 252 call. So that's good for me if I had done nothing to begin with. And it ended, look at this crazy drop in the last 15 minutes. It ended the day at 246. It closed the day at 246. So if I had done nothing, remember my original strikes were 252 and 232. If I had done nothing, I would have kept the full $150 because the SPY ended up closing between both of my strikes. But it really happened in a fashion way. Like it was at 254 with 20 minutes to trade. I did not expect it to drop this much and drop below 252 in the last 15 minutes. So because I kept rolling up my put strike, my put ended up being the one that lost me money, and ended up closing the whole trade for $3. There was still so much time value left in the spreads for some reason, in the options. I think because there's still trading going on after hours, so I think that's why it did not really expire to zero. There was still time value left in the option. So even when the SPY was trading at around 250, 247, 248, I was only able to close it for $3. So I closed the whole spread for $300, but remember I collected $253. So my loss, so I ended up losing on this trade, but I lost maybe $50. But what's really frustrating is that if I had done nothing, if I didn't make these trades over here, this 1 and 2 over here, these two are really the the ones that cost me the trouble, is I would have made a profit of $150. Or my other mistake is I should have closed the trade at 50% when I had the chance. Or the other mistake is maybe I should not sell calls and I should just stick to puts. Usually puts, I do better with selling puts, and the probabilities are better when you sell puts, and you can collect more credit when you sell puts. So maybe that's the other mistake, is I sold calls. So I'm trying to figure out what mistake I made, because I don't think my mistake of managing was incorrect, because when the SPY was trading at 256, there's no way that I don't do anything. It's already past my 252 call strike, so I have to take action. I have to do something. Either I close it or I bring up the put side to collect more credit. So I don't think I did something wrong by collecting more credit by rolling up the put side, but probably what I did wrong was not closing the trade earlier when I had a chance, and probably selling calls when I shouldn't be selling calls. Because if I had just sold the put spread, I would have made money. I would have kept that $70 that I started with. So the next expiration on the SPY is March 27th. So it's Friday. So I'm going to try again this trade tomorrow, but I'm going to sell a put spread only on same day expiration, March 27th. And another thing I learned yesterday, though, it didn't happen to me, but your broker can close any options that are in the money starting at 2 o'clock Eastern time. So 2 hours before closing time, the broker could start closing your in the money option. So in this case, my call was in the money after 2 p.m. After 2 p.m., my call was in the money, and they could have closed it automatically for me. But it rarely happens, but usually they'll do it if they see that your account cannot afford getting exercised or assigned the in the money options. So starting 2 p.m., your broker could start liquidating some positions for you, or not liquidating, but closing your in the money options. So that's something I have to be careful with, because sometimes I might hold on a little bit longer hoping that the trade becomes a winner, but if my broker closes it for me automatically, then they just ruin the trade for me. So ideally, I would want to start off with a put spread and try to close it at a 50% profit throughout the day or before 2 p.m. so that the broker doesn't involve themselves. And also, this is only one contract. So it's, if I make a profit of $50, let's say, I mean, I'm not going to live off $50 3 times a week, right? So eventually I want to scale this strategy. So I need to have something more sustainable, a strategy that is more sustainable if I'm dealing with more contracts, more capital, because I'm not going to accept on one contract, my max risk is, let's say if I collect $70, my max risk is $430. But if I'm doing 10 contracts, my max risk is $4,300. So I cannot let the trade reach max loss. So there has to be a better way of managing a trade that goes against me. Either a stop loss, for example, at 3 times the initial credit received, or if I sell a put spread, let's say, and then the market drops, then I could sell call spreads to collect the credit. It reduces my max loss, but I'm still vulnerable to the broker closing my trade early for a loss at around 2 p.m. So I still have to figure out what would be my management style in terms of a trade going against me. I like bringing up the other side or bringing down the side that's not tested. So if I sell a put spread and the market drops, I like selling call spreads because it acts as a hedge, and it also gives me a chance to win by the end of the day. Because who knows, the market could drop, but then towards the end of the day, it comes back up within my profitable range, like it did yesterday. If I had done absolutely nothing, this was a profitable trade, and it respected the probabilities that I presented here at the beginning. So the SPY closed no higher than 3% of its open price and closed no lower than 3% of its open price as well, easily. It moved a lot intraday, but at the end of the day, it closed within these probabilities. But I just didn't trust the probabilities because, of course, I saw the call spread getting completely tested. So I had to take action. I guess I can't regret taking action. I think it was the right thing to do. But I guess I should have closed it earlier when I had the chance. and maybe not sell calls, because calls tend to be more annoying and cause you more trouble. All right, so just wanted to share this trade with you. I definitely do like selling same-day expirations because, like I mentioned in my other videos, I'm getting as much as I'm getting when I sell a 30-day put spread. And I still have some 30-day put spreads that I just can't get rid of yet because VIX is so high, I'm not able to close, and because they just keep getting tested. Right now, my best put spread is this one here, 210 strike, April 15. It's profitable. It's finally showing a profit, but not enough for me to close. And I still have until April 15. I've got 20 days to go. And who says that the market doesn't drop below 210? And by holding it for 30 days, I'm exposing myself to after-hour movement. So that the market could open already 10 points or 20 points down on the SPY, and I can't do anything. I'm already in the trade. But when I do daily expirations, the movement already happened, and I'm just dealing with the aftermath, the leftover movements. And based on probabilities, I have a good chance of winning if I choose the right strikes, of course. So I'm going to keep trying this trade. This is my second trade. So I did it on Monday, and it ended up making a $70 profit with a put spread. Did it on Wednesday. My put spread was going to be 100% profit as well, but because I sold a call spread as well, I ended up ruining the trade by over managing. Because if I had done nothing, I would have won on the put spread and the call spread. But if I had just done the put spread on Wednesday, I would have won. I did the call spread and I over managed, and I ended up turning the trade into a loser. But at least it was only a $50 loser instead of something bigger, right? So yeah, so let me know what you think of this trade in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.